Thank you, Dick, and thanks very much for inviting me to this conference. We have a fantastic panel today to talk about some very topical issues. We're going to run it similar to the last panel, which is we're going to go in order down here, reverse alphabetical order. People have about 10 minutes of introductory remarks. Some folks have slides. Some people may come up here to use them. I did not want to pre-commit to the exact questions I was going to ask them when we had our call about this. Our Zoom about this was 2 weeks ago, and we all agreed, who knows what's going to happen in the world in the next 2 weeks. Let's not pre-commit to any questions. So I'm going to listen to these presentations and ask some follow-ups and make sure that we have enough time at the end for audience questions. I do want to start because with a Volcker story, because I think every panel should have one. I really like the tradition that we just started, which is we were having our annual conference at Yale 7, 8 years ago, and Volcker came as a headline superstar, and we are just starting our new master's degree program in systemic risk that Nellie Liang taught in for many years. Thank you. And so we had brochures, and they said master's degree in systemic risk, and Mr. Volcker saw it. And he said, systemic risk, eh? Are you for it or against it? We still haven't decided. All right, without further ado, Nate, take us away.
Great, thanks. Thank you, Andrew. Thank you for hosting this great conference. I thought I would talk a little bit about contagion, leverage, and liquidity risk from the perspective of the U.S. Treasury market in particular, where I've spent a lot of time. So I'm at BNY, and I head up our tri-party repo platform for product purposes, and then also spent 25 years at the Fed prior to that. And when I think about the Treasury market, I'm going to tell a little story too, but it's not going to be a Volcker story. It'll be a Hamilton story. So
almost as good.
Yeah, almost right. Hugely better. So if you go back to the foundation of the U.S. government debt market, so Alexander Hamilton's the first Treasury Secretary, right? He basically tries to consolidate the nation's debt after the Revolutionary War. And he basically says, our national debt can be a national blessing. And then he basically says with 3 conditions. 1, that it can't be excessive. And then he goes on to say the attributes of the Treasury market. And the 2 most important attributes, the fundamental attributes of the Treasury market, not exactly these words he said, but I'll say them in this way, are safety and liquidity. And he describes that basically a Treasury instrument needs to be paid on the terms of the contract, that the government is going to give you that instrument, that you're going to get cash back for your Treasury debt, and that the market's going to be safe. And then second, that it's a liquid market, meaning debt can be converted to cash. And those are the 2 fundamental attributes of the Treasury market, I would argue. And I think the Treasury market has been spectacularly successful. It's a $29 trillion market today, and it is the most important sovereign bond market in the world. It's the deepest, most liquid sovereign bond market in the world, and that is a huge national asset to our country. I bring these things up because in the context of liquidity risk and contagion and volatility, what we've seen in the Treasury market in the last decade are these episodes where the Treasury market hasn't been quite as safe or maybe as liquid as investors might hope. And so, and I think arguably we've seen that in the last 3 weeks too, as well. We've seen these sort of tremors within the Treasury market again. And I think, so I want to talk a little bit about safety and liquidity and how we can continue to focus on those things. And let me just start by putting in perspective of the last 3 weeks. So we've seen obviously significant volatility in the last 3 weeks. Of course, equity market volatility, the VIX, the S&P moving in ranges that are quite unusual. And in the rates market, the 10-year has swung in the 70 basis point range within a week, which is a huge amount of volatility in that market. And the 30-year bond has even been more volatile. And I'll talk about some of the things that I think were driving that volatility. But what has been unusual from my perspective is the funding markets have been relatively stable, right? So despite this volatility in equity and rates markets, funding markets have been stable. Maybe there's a nod to the Fed here and the ample reserve system. There's been ample liquidity in the banking system. But even with the amount of reserves in the system, 2 weeks ago, we saw pressure starting to rise in repo markets in the morning time. That's a sure signal that there's funding market pressures that are building, that even though there is sufficient reserves in the system, that players are becoming concerned and are seeking cash. So there were signs of that just prior to the tariff announcements being postponed basically for 90 days. So that precautionary build of liquidity was beginning. We also saw very significant moves in swap spreads. So we haven't seen them in the cash futures basis, which I'll talk a little bit more about, but in swap spreads, very significant moves in swap spreads, perhaps suggesting some unwind of levered positions there. And when I think about the fundamental factors, of course, we all know that trade policy and tariffs were one source of uncertainty that were driving this. Which countries, what assets would be included, when would they be implemented? But that, I think, that uncertainty spilled over into some core sources of uncertainty that then created outcomes that began to really diverge. So if you think about the fundamental outlook for the global economy, inflation expectations, you think about Fed policy, what way would it head? What is the Fed going to do in the face of these tariffs? And then also term premium itself. It's like the definition of uncertainty going higher. But I would also argue that what has happened over the last 3 weeks started to again raise questions about the safety and liquidity of the market. So on the safety front, the swap spread moves raised questions about leverage in the treasury market. And on the liquidity side, you have this large and growing supply of treasury securities. And I think what we've seen and heard is that foreign investors in particular started asking questions about their demand for US assets. I think when you look at some of the data around foreign flows, I think you can see that foreign flows have sort of moved away. You can see that in certain in yield comparisons. So if you look at treasuries versus boons, you can also see it in flow data. We have a lot of flow data at BNY where you can see that there's been sort of a pullback to some degree. I don't know that these things are, it's hard to say whether these are permanent. I think there's a lot of reasons why the US dollar remains the world's reserve currency. And so that's not something that goes away in 3 weeks. But I do think these are signs that we need to be thinking carefully about safety and liquidity in the market. So let me talk about safety first, and the cash futures basis trade. It's one example of a basis trade that can be conducted. Swaps is another basis trade. There's plenty of bases out there that can be traded. And generally, these are convergence trades, and they generally require significant amounts of leverage. So the cash futures basis trade, typically 20 to even 100 times levered. So a very significant amount of leverage is going into these positions. The basis trade, I think, has been estimated around 800 billion in size at the moment. We haven't seen a significant unwind of that in the last three weeks. And what I would say about these types of basis trades and leverage more generally in the treasury market is that they serve a purpose. And that purpose is to take a basis and basically make the market more efficient. So if you look at something like a treasury yield and a futures yield, these are economically equivalent instruments. So they ought to be priced in the same way. You shouldn't have significant divergences in those prices. So when you think about the role of levered players in the treasury market, I think they play an important role. I think they play a role in creating a diverse marketplace that makes it much more efficient, that lowers funding costs. So that's all very positive. But I think when you see that the changing nature of the treasury market, that it's shifting, you also have to think about what are the implications for treasury yields, what are the implications for the treasury market's behavior in times of stress. And that, to me, ties directly to risk management. And so we've seen a number of entities on the public and private side have put out, for example, best practices for managing this risk. If we're going to live in a world where the treasury market, where $3 trillion of the treasury market is owned by hedge funds, which, by the way, is larger than China and Japan combined, right? The treasury market is going to behave in a different way, and we need to expect that the treasury market needs to be risk managed in a different way. So a couple of groups have come out, a few groups have come out with best practices in this space. One is that the CFTC's Market Risk Advisory Committee came out with best practices for the cash futures basis trade. That includes practices to manage liquidity risk. including the risk that margin costs could increase rapidly and significantly, or that financing becomes reduced or unavailable. They also recommended that cash futures basis participants monitor and manage counterparty credit risk, including through effective due diligence, onboarding, credit risk mitigants, and continuous monitoring processes. So that would include things like margin. The Treasury Market Practices Group, this is a group that's sponsored by the New York Fed. They recently came out with best practices for repo, for risk management of repo transactions, also underlying the cash futures basis trade and a lot of funding activity in the Treasury market. There, they recommend that all Treasury repo should include prudent haircuts or margin on the value of the securities in concert with other risk management techniques. So that's very important. Margin is a well-known, well-understood way to manage counterparty credit risk, and that counterparty credit risk exists in the Treasury market, right? Just because the instrument's safe doesn't mean you don't have counterparty credit risk. The third area to make the market safer, I would point out, is central clearing, right? So this is SEC's rule around central clearing. Central clearing interposes a CCP between counterparties. It should reduce counterparty credit risk. That should mean that in times of stress, like we've seen in the repo markets, people are less likely to pull away from their counterparties because you're now facing the CCP. The CCP has default management, it has liquidity management, it has margin. But the central clearing rule only applies to the members of the CCPs. What those members do with their clients in terms of margin management is up to them. And that's why I point out that the best practices are an important piece of the puzzle when it comes to managing risks and making the Treasury market safer. So what about liquidity in the Treasury market? Let me mention a few things that I think are important on the liquidity front. In a market that's 29 trillion and is headed to 50 trillion in the next decade, liquidity is just as important. It's like an equal principle supporting the Treasury market. And there's three areas that I think could be focused on to make the Treasury market maintain its liquidity going forward. One is regulations. I think the examination of the leverage ratio is an important study that's going on right now. Removing reserves and treasuries from the SLR and the Tier 1 leverage ratio, it's a form of targeted reform that I think could help intermediation in the Treasury market, right? I think that there are other changes you could make to leverage ratios that would perhaps help other asset classes. But I think if your goal is to make the Treasury market liquid, then I think you need to think about targeted reform of the SLR and the Tier 1 leverage ratio for treasuries and for reserves. In terms of the second area is the efficiency of public liquidity backstops to make the Treasury market liquid. And here I would just point out that there's been a lot of progress around the standing repo facility. That's a huge structural change to the Treasury market. You now have a facility that's available every day. The Fed's also tinkering with that facility. They've added early morning settling standing repo operations, meaning that the cash that's injected from the Fed isn't late in the day, it's early in the morning. So now they've had examples where they've run 2 operations a day. That's important because liquidity is no longer done in 24-hour cycles. Like if you have liquidity pressures, they can occur in the morning, so late day cash may not help you. So I think that's very important. The second thing is that the standing repo facility, I think, would benefit from central clearing. And that's simply because the liquidity that comes from the Fed has to be intermediated. And if that increases a dealer's balance sheet to intermediate that liquidity, that could be 40, 50 basis points of cost, a very significant friction in that flow of liquidity. Central clearing would take that off the balance sheet, and it would make it much more efficient to pass along, including to non-bank financial institutions. And then lastly, I would say the third important dimension of liquidity in the market is innovation in liquidity markets. So there, I think of the funding markets. They've been built on 24-hour cycles. You look at repos, they're basically 24-hour instruments. But as I said before, liquidity is needed in smaller increments. It can be minutes, it can be hours. We've launched intraday tri-party repo, which allows collateralized funding to happen on as little as 1 hour period. You could do an hour, you could do 90 minutes, whatever you want to choose. It's dynamic. But I think a marketplace like that is important because it can provide liquidity that's collateralized and backstopped by treasuries on in smaller increments. And I think we need to see more innovations like that, more innovations around collateral mobility so that you can move liquidity to the right spots, including to the discount window, including to the standing repo facility as needed. Super important. So I'll leave it there, but I'll just close by saying I think the safety and liquidity of the treasury market is super important. And I think, continue to examine both of those principles and how we can drive improvements in both is essential.
Thank you, Nate. Okay, next we have Christy, I think, has some slides. Okay, and
Good morning, everyone. I'm Christy Jensen. I'm an assistant professor at the University of Southern California, and I'm also affiliated with the Dutch Central Bank. So it's the usual disclaimer applies, and these are my own, not those of the Dutch Central Bank or yours. So I've also done quite some work in the treasury market, but for today, I actually wanted to specifically talk. I'm not sure what's happening. Yes, maybe now it is okay, perfect. So the work that I want to talk about today is the liquidity risk in a specific sector, where we perhaps start before, like say 5 years ago, that risk was pretty much not existent. So that's liquidity risk within the pension sector. Now, pension funds are often seen as being rather stable long-term investors. And indeed, if you think about their objective, they aim to maintain strategic asset allocation, so stay 60% invested in stocks, 40% in bonds. What's going to happen when interest rates rise? They would actually buy bonds when bond values drop to rebalance back to that strategic asset allocation. So this basically shows that pension funds tend to stabilize markets and behave countercyclically. Now, the most important reason, though, that we don't think of pension funds as being quite exposed to liquidity risk is that, unlike, say, banks and mutual funds, they don't face withdrawal risk. So the only way that employees can basically switch pensions is by pretty much changing employers. Now, of course, the UK pension crisis in 2022 has challenged this view quite a bit. So to make sure that we're all on the same page, in September and October of 2022, interest rates in the UK were rising rapidly, especially because of the announcement of the mini budget in the UK. And pension funds actually lost a lot of value in their derivatives contracts, in particular swap contracts. And as a result of that, they had to post cash collateral into margin accounts, but they didn't have that cash. So they had to start selling assets, and they specifically sold UK gilts, which further amplified the rate hike. Now, in this study, I'm not going to look at the UK. I'm actually going to use the Dutch pension funds as a laboratory, where we are going to look at a much longer horizon between the systematic link between the hedging activities of pension funds and their exposure to liquidity risk. So basically, just to summarize the research in a nutshell, so first, we want to understand why do pension funds use swaps to hedge the interest rate risk that they have because of the long-term duration of their liabilities. And basically, regulation, not just in Europe, but everywhere in the world, they pretty much focuses on the interest rate risk that pension funds face. But margin calls from derivatives has been pretty much ignored till a few years ago. And why would pension funds want to hedge using swaps? Well, if pension funds want to hedge, they can either go invest in a long-term bond or use a swap. Now, the advantage of a swap is that they don't have to really give up any balance sheet capacity in order to hedge against interest rate risk. So they can just maintain their, say, risky asset allocation as it is, but still hedge against declines in interest rates. So it's an attractive feature for them. And indeed, we show that especially those pension funds that are worse funded tend to use swaps a lot more. Now, that has implications for liquidity risk. Why? Because if interest rates go up and pension funds hedge against the decline in interest rates, the swap positions would lose value when interest rates go up. And we show that those margin calls can be quite substantial, so 6 to 15% of their total assets. Why is that a problem? Because their cash buffers are typically only 1 to 2% on average, with at maximum 9%, so not enough to cover those margin calls. So as a result, they have to sell assets, and we basically show that they resort to selling rather safe, shorter-term euro bonds. So think of German and Dutch short-term bonds. And in turn, this has basically
impact on financial markets. So those episodes where interest rates go up because of the selling pressures coming from pension funds, we see an even sharper rise in interest rates. Now, why do we focus on the Dutch pension sector? I wish I could have done this in the US too, but as some of you may know, there's just not good quality data on pension funds. And actually, we do have that for the Dutch pension sector. So also for everyone, even though the country is rather small, it's a big pension sector. So we're talking about 2 trillion in assets under management. And the pension funds report lots of details. So they're on a quarterly basis, we know their funding ratios, the durations of their liabilities, the swap usage, and so on. And we have that over a 10-year period, so 2012 towards the end of 2022. And we also know for the majority, or the biggest pension funds at least, their monthly portfolio holdings at a security level. So we exactly can identify what they are selling when margin calls occur. Now, just in the context of this talk to understand how regulation works for these pension funds. So basically, there's 2 key matrices. So one is the funding ratio, so the assets versus the liabilities, where the liabilities are valued using market interest rates, so specifically Euro swap rates, as well as a required funding ratio that just works like a VAR constraint for banks. Pension funds need to hold more capital if they, for instance, are more exposed to interest rate risk. That's why they have a big incentives to hedge that interest rate risk. At the same time, EMIR, so the European Market Infrastructure Regulation, requires pension funds to post collateral on their derivative positions. And since recently, this actually has to be exchanged in cash. So that's the central clearing that we talked about in the previous presentation as well. Now, with that background, let me show you a couple of side aspects in the data. So basically, the first important thing to note is that over time, pension funds have been using more and more swaps. So at the start of our sample period, 75% of the pension funds were using swaps. That's almost 100% towards the end. Pension funds also use swaps to dynamically hedge over time, and they get the majority of the duration from swaps. So how do I get to that conclusion? The duration of the liabilities of pension funds hovers around 19 years. If you just look at their loan asset only portfolio, so pretty much their fixed income portfolio, they get 4 years duration from there. So basically, typical fixed income portfolio has a duration of 8 years, and they invest about half of their assets into fixed income. This gives you a duration of around 4 years. Now, when you add to that the swap duration, which is the purple dashed line, we see, first of all, that a lot of the durations, so around 5 to 6 years, they obtain through swaps. And we also see that that's the one that's moving over time. So pension funds use swaps to dynamically hedge. Now, finally, pension funds actually have larger margin call risk than the cash buffers they have available. So here I compute their margin call risk, which is basically just the duration of their swap portfolio times the increase in interest rates. And I subtract from that the cash that they have available, and we basically find a lot of them are on the right of this graph. Sorry. So 75% of the observations on the right of this graph, meaning that they don't have enough cash to fulfill the margin calls. Now, so if they don't have enough cash to fulfill the margin calls, what are they selling when these margin calls occur? Now here I plot the changes in active changes in bond holdings for all bonds, which are the blue bars, and then for AAA Euro government bonds. So think of them as the Dutch and the German government bonds. So we see that in periods of interest rate surges, which we define as periods where interest rates, or basically a 20-year swap rate, increase by more than 40 basis points. So during those periods, pension funds are not really selling in the aggregate bonds, but they're specifically selling AAA Euro government debt. So basically, when interest rates rise substantially, so we had that in May and June of 2015, March 2020, and of course, several episodes in 2022, the pension funds start to sell their safest bonds. And we show in the paper that this is primarily driven by shorter term government bonds, so with a maturity below 10 years. So from the perspective of the pension funds, shorter term. And also the most negative drops or the most heavy sales are driven by pension funds that are very much exposed to margin call risk coming from their swap positions. Now, the final thing I wanted to show you is basically the price impact of all of this. So what we do as a final step is that for every bond that all the pension funds hold, we compute the exposure of the bond towards margin call risk, meaning the likelihood of those bonds being sold because pension funds are facing margin calls. And basically just because I'm running out of time, the rough conclusion from this is that when bonds have a lot of exposure to margin call risk, so the risk that pension funds are going to sell those bonds when interest rates hike, those bonds drop more in value at the time they face these margin calls. So they indeed amplify market movements. So let me conclude with that. So pension funds increasingly use swaps as a hedging tool for interest rate risk. And that is going to lead to margin call risk or liquidity risk that can be quite substantial. So 15% of their total assets. What are the implications of that? When interest rates surge, they start to sell their safe euro bonds to fulfill those margin calls, which further amplifies the rate hikes. And therefore, this idea that pension funds are stabilizers in financial markets actually doesn't hold true in states of the world where we have this rapid rises in interest rates, and they actually act pro-cyclical like the other market participants typically do during those times as well. So thank you very much.
Okay, David. Also
Thank you.
going
I
up.
will also go up
Great.
to the lectern. Yeah, thank you. Great, thanks. Okay, so first of all, thank you to the organisers for including me on the programme. It's great to be here. So today I'm going to kind of talk about two very closely related papers, which both look at the role of non-bank lenders in monetary transmission, in particular within the corporate loan market. So one of these will be looking at this question in the domestic US context, so kind of home, not really my home, but home here. And the other will be looking at it in the context of international spillovers. This is joint work with Ralph Meisensal from the Chicago Fed, Jose Luis Pedro and Bryce Turner, and I'll leave the kind of details of the papers at the end. I should, of course, also note the usual disclaimer that these are my own views, not necessarily those of the Bank of England. Okay, so the kind of big picture context for this paper is really the large literature, the large and old literature on the bank lending channel of monetary policy, which kind of dates back to the 80s, which really finds when monetary policy tightens, so for example, an increase in the Fed funds rate, this leads to a reduction in bank credit supply. Now, there could be a few mechanisms underlying this, and these may have changed over time, but I think kind of in recent times, a couple of kind of likely relevant ones are first is the idea that higher interest rates reduce the value of long-term assets, which can therefore cause falls in bank equity and hence tighten bank capital constraints, particularly if they're already close to regulatory minimum requirements. In addition, higher interest rates, higher Fed funds rate could lead to increases in rates on money market funds, say, which can then attract some deposits away from banks, which are paying low yields on their deposits. And this could therefore kind of make it more difficult for banks to fund new loans. Now, in general, these things are quite helpful for the monetary policy maker because they mean that the monetary policy tightening, so this reduction in credit supply helps to dampen economic activity and inflation in line with the intention of the monetary policy tightening. However, more recently, there has been some research suggesting that there can be kind of unintended consequences from mechanisms of this sort once we look across borders. So in particular, there seem to be quite strong international spillovers from US monetary policy. So tighter monetary policy, which is intended to reduce inflation in the USA, can lead to tighter financial conditions globally. This could have financial instability implications and generally lead to volatility in these other countries, which has been a kind of a concern, particularly for policymakers in emerging markets. Now, the banking sector can be a source of amplification of these spillovers. So, for example, because a stronger dollar following the tightening can weaken the balance sheets of non-US borrowers and therefore reduce banks' willingness to lend to them. And also, in general, banks have tended to be found to be kind of more sensitive to, well, when there's increases in risk, they tend to kind of reduce cross-border lending in favour of domestic lending. So what we do in these two papers is consider how non-bank lenders might fit into all of this. So this is, I think, an important question, as has been discussed or to some extent debated today. There's obviously been a large increase in the non-bank share of financial markets globally. So the FSB data suggests non-banks now make up around 50% of total global financial assets. And within that, a smaller proportion of the loan market globally, but still about 15%, so still a kind of non-trivial part of the loan market. It's also an interesting question empirically because some of the features of the banking sector that potentially underlie the bank lending channel do not apply in the same way to non-banks. So it could be that non-banks react quite differently to monetary policy. So in particular, non-banks tend to have weaker regulation, including capital regulation, and also they sort of kind of by definition, arguably don't use deposit funding. So the setting for both of these papers is the syndicated corporate loan market. In the domestic paper, we actually also look at a couple of household credit markets, but I won't talk about those today. So this is, of course, an important source of credit for large corporates. So we're talking here about the broadly syndicated market rather than the private credit market, so kind of a bit of a bigger loans and bigger firms on average than were discussed in the previous section on private credit. So this market is kind of similar in size to the corporate bond market, depending how you measure it, and is also a particularly important source of cross-border credit. Another reason why this is a very helpful paper for us, a helpful market for us to study, is that it has very nice features from an identification perspective. So in general, syndicated loans are loans which are too large for one lender to hold, and so they generally involve multiple lenders contributing credit to the same loan. Now, this is very helpful because it helps us to identify credit supply, because we can compare how different lenders lend to the same borrower at the same time. So more specifically, we use fixed effects at the level of the borrower and the time, or even the level of the loan. This kind of controls for the borrower's credit demand, among other borrower level features, and means that the variation we're using is therefore can be driven by credit supply. Now, the lenders in this market include both banks and non-banks, which is obviously crucial for our paper. Now, who are the non-banks? So the syndicated loan market has a primary market and a secondary market, so we have to kind of think about them a bit separately. So in the primary market, so where the credit is initially provided to the borrowers, this is kind of dominated by commercial banks. However, there are some non-banks who are active, such as broker-dealers or investment banks and finance companies. However, in the secondary market, so shortly after a loan is issued, the original lenders will tend to sell portions of this in the secondary market. And here there's a much larger role for non-banks, so particularly collateralized loan obligations or CLOs, but also mutual funds and various other institutional investors. Now I've indicated here these percentages that non-banks may be sort of 10% of the primary and the majority in the secondary. I mean, these numbers are not intended to be particularly precise, obviously this varies over time and so on, but that should give you a broad ballpark. Now, without wanting to go into too much detail, I should note that in the two papers that we do look at different parts of the market for identification, for the reasons of data availability. So in the international paper, we're using this commercial deal scan dataset, which only captures the primary market, whereas for the domestic US paper, we're able to use a regulatory dataset called the Shared National Credit Dataset, which also incorporates the secondary market, so it's kind of a more comprehensive coverage. Now, in both papers, we find pretty similar key results. So in both cases, we start with a loan level analysis, where we look at the credit provided by lender L to borrower B at time t, and our key variable of interest is this interaction term in red between the indicator variable for non-bank lenders and then a measure of the monetary policy stance. We use a few different measures, including monetary policy shocks, but I won't go into that here. Now, in both cases, what we find is that the coefficient on this interaction term is positive. So what that means is that when monetary policy tightens, non-banks increase lending relative to banks. So in other words, non-bank credit supply is less sensitive to monetary policy than bank credit supply. And this holds both in the domestic US context and in terms of international lending. We then turn to a borrower level analysis. So here we regress various balance sheet items from the borrower on another interaction term, this time interacting monetary policy with some measure of the banks, also the non-banks kind of exposure to non-bank credit. They're kind of based on past relationships and so on. Again, we find a positive coefficient. So here I focus on investment. So what we're finding is that when monetary policy tightens, borrowers with better access to non-bank credit tend to increase investment relative to borrowers without such access. So in other words, this kind of relative increase in non-bank credit at the loan level does seem to support corporate investment. Now, the paper has a number of policy implications. So our finding that non-banks weaken domestic monetary transmission is arguably a concern for the policymaker, because this means that some of their key monetary policy tools are potentially weaker than otherwise would have been the case. So non-banks might be weakening monetary transmission, and also some other papers, I should note, find similar results in other contexts. However, our results on international spillovers arguably have a more kind of positive, given a more kind of positive interpretation. So we are finding that in some contexts, non-banks can act as kind of shock absorbers by reducing some capital flow volatility. Now, that last point might sound like a slightly surprising conclusion, because I think often we think the non-banks, because they're less regulated, got weaker liquidity, tend to be more fragile than banks. And indeed, there are quite a few papers that find that in the syndicated loan market, non-bank lenders are indeed more fragile in the context of financial crises. However, what we're finding is that we're able to highlight a setting where actually non-banks are less responsive to certain shocks, in particular monetary policy shocks here. So I guess this emphasizes that there's a lot of heterogeneity, different types of institutions, different markets, different types of shocks, not necessarily a kind of one-size-fits-all interpretation. Potentially also suggests some trade-offs. So it could be that if you have more access and use of non-bank credit as a corporate, then this potentially protects you somewhat during periods of US monetary policy tightening, but might also make you more exposed during certain financial crises. So I'm kind of running out of time, but I'll very just quickly note that I should, of course, say something about what could be driving this difference. So we do consider a couple of different candidate explanations. I think across the two papers, probably the most consistent finding is that there could be differences in regulation between banks and non-banks could be part of the explanation. So in particular, what we do find is that its increase in non-bank relative to bank lending is larger for less regulated non-banks, and also for credit to riskier firms, which is consistent with the idea that monetary policy kind of maybe tightens bank capital constraints, makes it more difficult for them to do foreign lending, whereas non-banks are a bit less constrained and therefore can kind of step in as banks retrench. So I'll leave you, so that brings me to the end, and I'll just leave you with the details of the two underlying papers in case you're interested. So thank you very much.
Okay, last but not least, my Yale colleague, Stein Plazas.
Thank you, and thanks for inviting me, Dick and Rob. I'm going to be speaking a little bit more in general terms. I don't have a paper to present here, although there's a paper that I wrote a few years ago about non-banks and how you should think about macroprudential and other policies. So not easy. So let me pick up a little bit on the presentations and also what Nat told. So I'll do that about monetary policy and financial stability separately. So monetary policy, just to step back a little bit, we know it's not just about quantities in terms of money supply. That's passé for a long time, nor it's necessarily about the interest rate only, right? So we think about financial conditions that we're trying to change in the world in the financial sense. And the bank lending channel is a good example of where financial frictions start to play a role in transmitting the monetary policy shocks or the changes in a certain way, maybe even adding to that, amplifying that. So now for non-bank financial institutions, things can go different ways, right? Because in an interest rate increase, for example, some non-banks like banks may suffer in the sense of having reduced capital available, real capital if you measure it. But there are also other parts of the non-banks who actually benefit from an increase in interest rates. That goes back to what Christy on the pension funds. A long duration pension fund typically has liabilities are longer than the assets, so as in the case of the Netherlands. So you get a big benefit from your discounted value sense on your capital. So those non-banks, when there's an interest rate increase, may actually serve the role that David was trying to tell or show, that they're trying to mitigate the monetary policy and actually go the other way. So you have an asymmetry here that is quite different from what we typically think about the monetary policy for banks. So I think we need to assess these asymmetries, not just the regulation, I would say. It's a lot about financial frictions more generally. How do you set up your non-banks? How do you operate them? We should do think about the coverage of the regulatory perimeter, of course, as well. Non-banks differ there, again, very big, very greatly. But we may also have to think about the monetary policy regime, because in some circumstances, some of these non-banks have direct access to the central banks or money market funds. Then the pass-through of interest rate changes is very direct to them and not what we may have in mind going through the banks per se, which is maybe our traditional model. The non-banks get funding from the banks, and for that reason monetary policy runs through the banks. But I think that's not always the case and not everywhere the situation. So that brings me a little bit also to a question for David. What was the channel that actually you call it on the regulatory side, the big channel? I suspect it was also partly this increase in capital positions for some of the non-banks, like the pension funds, that actually made them extend more, because to have an increase in the interest rates and as a non-bank to start lending more to even offset what the banks are doing, you're taking quite a bit of extra risk, right? So is then the regulatory constraint that perverse that you start taking even more risk? That seems to me quite a large. So I'm putting more weight a little bit on that positive shock to the capital position. So regardless, I think in monetary policy, we need to adjust to the presence of the non-banks. I don't think it's necessarily that difficult. Let's take the euro area. There are many differences in the euro context in terms of how banks are funded and how the asset structure looks like. Floating rate mortgages exist in some countries within the euro area. Others ones have more fixed rate mortgages. Same thing on the corporate side. That heterogeneity would give you different monetary policy transmission, but it doesn't make monetary policy impossible in the euro context. I think they have a good record there as well, that they can't pass it on. So I think it's more a matter of learning, but the one difficulty there I see is this asymmetries, and the non-linearities can sometimes surprise you. So you think you have transmission working the right way, considering everything, and then suddenly you have this surprise. So that brings me also to financial stability. Obviously, big topic. So many new things that we're talking about today. I think it's probably often useful to go back to the core issues, leverage and liquidity. I think are the two. I didn't hear it as much yet, but I'm sure we're going to get back to that. And I would there also bring monetary policy into the picture and saying that, and Jeremy Stein had this getting into the cracks story, that's even more relevant when you have monetary policy to mitigate some of the risk-taking behavior that's happening in the non-banks, because you don't have any other tools to use. So you need to get out there using monetary policy. Having said that, and this is maybe a slightly different take than David had, I think the non-banks are more pro-cyclical in many ways. If you look at the evidence, and you cite some of it, although your own evidence is a little more nuanced, both domestically and cross-border, we know NBFIs react much more to the excess bond premium, which is an indicator of financial conditions. We have a little bit more flights from home if you have a crisis in your context, where you in your own country. So again, more pro-cyclicality, large increase in CDS spreads on the sovereign side when you have more NBFIs. And also we have had policy spillovers where clearly the non-banks react to macroprudential policies being implemented in one country and then try to circumvent those because they typically apply to the banks, and the non-banks try to go around those. So I would be a little bit more cautious there. And that more generally is of course true because the instability that we have in the non-banks comes from very different sources. Nate alluded to quite a few of those examples. I think there are many more. Dash for Cash, the breaking of the box, all the bad things we've had, Archegos and Greensill is also in that same order. And then Christy, what you mentioned, the LDI type of effects that you see also in the Dutch pension funds with some general equilibrium effects. I think that, by the way, that's very similar to what we saw in the low interest rate environment when there were papers written on the search for duration by pension funds, right? They wanted to go out on the long end of the curve, started buying more of those bonds, driving the interest rates even lower, and as a consequence, had a general equilibrium effect there. Now we've seen the reverse of that, but it's through the hedging mechanism that we think was going to help. So a little bit on the policy side, I think we're going to talk about it a lot. Adjusting monetary policy, already talked about that. On the financial stability, Nate didn't mention it as much, but regulation is still on the cards in principle, maybe not in practice, right? And you didn't mention the word best practices, which is a very light touch type of thing. So is it impossible for the hedge funds to do it, and that's why we don't go there, or is it practically or politically impossible? Maybe coming back to the bond portfolios as well, because you didn't go to the policy implications yet, but should we maybe not ask for duration matching for pension funds? Now this sounds like hereditary in the sense that we typically ask for a matched book for any institution. So why would we suddenly deviate for pension funds? Well, my argument would be that these pension funds are actually more pay-as-you-go franchise operations rather than managing assets for an individual person, for the beneficiary. So to the extent I'm in the Dutch pension fund because I was teaching there for the public sector, they have public sector people coming in, hopefully for the next indefinite period. They will pay off my pension obligations, presumably with new inflows. They
How
don't.
many pensions do you have exactly?
It's a small amount. My point is, you can run a pension fund with a high equity component and no duration matching if you have that inflow assured for a long enough period of time, and then avoid some of these things. Because one of my fears that we're matching regulation that we know for the banks and bring it over to the non-banks like pension fund insurance, but we're just basically transposing the same risk that we had there to those other actors, and we're not really gaining any benefits anymore from the diversity that they otherwise might be. So last thing, a few things. I think about you, Nate, who mentioned we need a little bit more facilities. And there was this booking proposal last week or the week before by Jeremy Stein and Andrew Kashyap and others. I'm not so sure. It's a very select group of actors that we then would design a facility for. Yes, they can create havoc, but what's the quid pro quo that we get in exchange for that? And then that wasn't clear from that proposal, but it's also not clear from some other things that are put on the table. And I'm going back to something that Don mentioned this morning, the Dan Terulio idea of a security financing tax for extending liquidity or credit to those actors is maybe a more useful way to go. Let's make it more costly. If it's only a few basis points that they're earning, well, maybe we need to also have a charge for them so they don't do that anymore. Lastly, on data came up quite a bit. And when I wrote this other paper, I was asked to write about data. I think we sometimes overdo the request for new data because we can still do a lot of triangulation with existing data. Now, the previous session already said, well, you could do that. The question is whether the OFR will do it. But if we ask more data alone, I think we're going to get perverse feedback from the industry and saying, well, there you go again. And I started with, let's say, the repository data on derivatives. It's a huge amount of data, but nobody was analyzing it, the central banks, because they couldn't absorb all the data. This was at least the European impression I got. So let's be a little bit more cognizant of what we already have. There's a lot of links, and I think in a way the paper by Viral and Booth and others in Nicola showed that already. You can triangulate and expose. We can triangulate the LDI crisis. We could triangulate the data that we had on the SVB problems much better. So I would put a little bit more faith on those kind of things than asking for more data.
Thank you, Stijn. Thank you. You did my job of making comments on all of the papers. So I think it's only fair I give the authors an opportunity to give a brief response, if you want to any of the things that Stijn said, and we can just start here and go down the table. So any particular thoughts, Nate?
Well, so best practices, I agree that I just wanted to respond to your comment on that, which is that I think best practices are maybe not so well understood, play a not so well understood role in financial markets. I spent a ton of time on best practices when I was at the New York Fed. The treasury market best practices are primary dealers in the US Treasury market are required to adhere to those best practices. So they have a bit of bite to them, right? But I think it's interesting because best practices can play this interesting role where they can either take the place of absence of regulation, they can complement regulation, or they can actually spur regulation. So we saw in the case of the Treasury Market Practices Group, they advanced margining of agency MBS forward transactions, right? That became a best practice. And just through the best practice adherence, you saw 80–90% of agency MBS trades on a forward basis being margined when they weren't previously. Then that spurred margining by FINRA to actually put it in place on a rules basis. So I think that there is a real role that best practices can play, and I therefore I think, especially in regimes that are backed by some official sector, where you have the combination of private sector and official sector together, and you can actually get tailored or principle-based practices that are grounded in the knowledge of market participation and then backed by the official sector to give them more oomph. So just a comment on that.
Christy?
Right. Yes. So let me also come back on Stijn points on like the duration matching of pension funds and insurance companies in general. So I only had 10 minutes, so I just wanted to point out sort of the liquidity risk aspect of it as our session is about. But indeed, Stijn is right in terms of like when interest rates go up, liability values drop even more. So in terms of like funding status, the pension funds gain. Now the downside, as I showed, is the liquidity aspect. Where they don't have any capital issues, but they just need to come up with the cash. And that's where we see this sort of selling behavior amplifying market movements. Now, so I think duration matching in itself is a good thing. So indeed, you exactly have this effect when interest rates go down. Your liabilities value increase, but at the same time, the swap value increases as well. So that you're basically at all stages of the will able to pay out your pensions. Now, of course, the question is how much should you do that with swaps versus, say, long-term bonds? Long-term bonds don't have the liquidity risk. Of course, there are not as many long-term bonds outstanding. And I just think sort of before what we saw in the UK, pension funds, the focus was just on the interest rate hedging and the liquidity risk was like basically ignored. There's like a zero capital charge on liquidity risk by pension funds. So I think like hedging in itself and even with swaps, is fine, but I think you need to think much more about like stress testing and do that potentially in a standardized way to make sure you can actually you have all the cash and you don't run into like fire sales when interest rates rise.
Thank you, Chris. David?
Sure. So thanks very much for the comments. I'll pick up on a couple of them. So you mentioned that the mechanism, so I'd emphasize this kind of regulatory explanation for what we were seeing. I really like your point that we should look beyond this idea that the regulators did it, and maybe there's something more kind of fundamental about the business models of the institutions. I mean, in particular, you mentioned the idea that the possibility that of pension funds increasing credit being driven by by the improved capital position when rates rise. We do sort of test that in one of the papers where we do look at in the paper looking at the domestic US context, where we have quite a range of non-banks because you have the secondary market. We do kind of look at which non-banks are driving the relative increase, and we don't find that pension funds are one of them in that context. So I'm not sure that's a huge driver in this particular context, but I do really like the idea of looking in that direction. I mean, I think another kind of sort of approach or another potential mechanism that works with business models rather than regulation is through the funding side, where in some contexts, I think tighter monetary policy can lead to relative funding improvements for non-banks relative to banks. And then I was going to touch on pro-cyclicality. So I definitely agree that the takeaway from the paper shouldn't be that non-banks kind of in general absorb shocks. There clearly are situations, much documented in other literature, where non-banks are more pro-cyclical. I guess we were highlighting the idea that that's not always the case, although I think it is quite plausible. We don't test this per se, but I think it's quite plausible that if you had a really sharp monetary tightening, then maybe some of what I was showing wouldn't hold. If there was a kind of a sort of a really sharp tightening shock, then maybe non-bank fragilities would come to play more. Finally, it wasn't really about my paper, but I just wanted to note that there is you kind of suggested that maybe the EMEA trade depository data wasn't being as fully utilised as it could be, and I think at the Bank of England at least there's some great work going on both in research and policy. So I mean they are obviously very difficult data sets to work with, but yeah, people are definitely doing some good work.
Thank you, David. So I'm cognizant of the time and want people to get a chance to ask some questions, but I have a lot, so I'm going to cut them way down and just a couple questions for Nate, and then a comment on Christie's. And the theme of these is how scared I am about some things. I mean, I'm an anxious person, and after conferences like these, sometimes I feel like I need to raise the dosage of my medication. On the treasury market, Nate, and I think you may have answered this question, but it was you didn't emphasize this, so I just want to make sure I heard it right. When the treasury market was having trouble a few weeks ago, I got a lot of questions. Is this a fundamental thing? People are dumping our bonds, or is this a plumbing thing that we're seeing? And it sounded like you were saying it wasn't really a plumbing thing. We didn't see. Okay, so if that's the case, how much of that fundamental thing do you think was a permanent shock? Because it doesn't seem like it should be zero. It seems like there should be investment committees around the world that said, it's finally time to talk about moving 10% of our money that's in US government bonds out. I'm just, what's your sense what kind of a permanent hit did we take?
Yeah, I mean, great question. I guess I don't think anything is permanent. I mean, you can always sort of restore the safety and liquidity of the treasury market if it became degraded. But I think the fact that you've seen as much in the news media, in the data that raise questions about foreign demand for US assets, I think itself is a sign that there's been a shock to the value of US assets and treasury instruments. I mentioned this earlier. I mean, it's actually difficult to get good data that would show some sort of like significant retrenchment there. Some of the flow data does suggest that foreigners have, stepped a little bit back, but that data ebbs and flows, right? That's exactly the nature of flows. But I would say that there's definitely a discussion happening around I think, and it's related to uncertainty around the predictability of US assets, given the uncertain possible outcomes around policy matters.
So let me ask you an uncertainty question. This is a question for everybody, but I'm only going to make Nate answer it, but you should imagine what your answer is in your head. Okay, so on a scale of 1 to 10, where 1 is not surprised at all, and 10 is extremely surprised, how surprised would you be to wake up to see the following tweet or truth? China has been very unfair to us. We must consider whether or not we should be making interest payments to them on the debt. 1 to 10.
I'm gonna artfully avoid giving you a number, but I guess
Closer to 1 or closer to 10?
well, look at if you look at like the reports around the Mar-a-Lago Accord, like even that kind of concept and I don't think anyone's taking that seriously right now, but I think in terms of how seriously you take it, it's certainly moved up in the rankings because I think people you have to sort of, if you don't have a understanding of the thesis under which policy is being operated, it makes the possible outcomes, I think, get wider.
I'm closer to 1 than 10. And then just a comment, Christy, on yours, so excellent paper, and thank you for presenting those results here. This is just something that you made me nervous about seeing, because I've been able to have some plausible deniability in the past that the pro-cyclicality of margining was just in my head, kind of, but given that pension funds, who you would think, if anyone, might be able to resist this. And we learned a bit, obviously, from what happened in the gilt crisis, but you have really good data. If they're subject to this, and we're moving to a world where we tell the CCPs, you guys need to be safe, and the way you're safe is to ask for more margin when things get volatile. So this is a comment. I mean, your paper just makes me a bit nervous that this is even a bigger problem than I feared, and it's one that we haven't adequately stress tested yet. And I don't really know how to do the stress test for it unless we can get the data on the margining practices across all of these exchanges. Okay, so there's a lot more I'd like to talk to you guys about your paper, but I think I should let the rest of the crowd talk. Why don't we take a couple of questions? Yes. This is your workout for the day, Matthew. You don't need to do any exercise.
Hi, my name is Isha. I'm an assistant professor at UBC. Excellent discussion. I have a question for David. So I was wondering if you can tell us a little bit about the funding sources of these non-banks and how that might be related to the dampening of monetary policy transmission. So I've done some work on monetary policy transmission through non-banks in the US mortgage markets, and I also find a dampened effect. But I find that because of a particular source, which is the collateral value. So, and that depends on the business model of these non-banks. So they have access to a collateral which increases in value when interest rates go up, and they get most of their funding from banks, and therefore banks are able to lend more to these non-banks during periods of interest rate hikes, and that leads to increased lending by non-banks. So I was wondering, what type of non-banks do you have in your model, and where are they getting their funding from, and how would an increase in interest rates affect their funding?
Thank you. Okay, I have a question for David now. So let's make sure we have a question for Christy and a question for Nate. So raise your hand if you have one of those. Yes.
Hello, Mike Alex from UBS. Just on this question of the pro-cyclicality in the Dutch pension market, and really the pro-cyclicality of the margining regimes in general. Who's buying what is being sold to make the margins, and what's the rebalancing? Do you have a theory of the rebalancing or settling effect that stops the margin calls?
Okay, and now Nate gets one if someone's got a Nate. There we go in the back. Yeah, I did that on purpose, Matthew.
I was wondering if you had an opinion on the recent Brookings Institute paper from Jeremy Stein et al. About the Fed stepping in to take on, the basis trade in case of that collapse. And
He's asking about the basis, the Stein and Anil Kashyap
can you hear me now?
that this Stein doesn't like.
Can you hear me now?
Yeah.
Yeah, so I was just wondering about your thoughts on the recent Brookings Institute paper on the Fed stepping in to take on the basis trade future positions in case of that collapse and setting up a facility ex ante. And just your thoughts on the extent of a central bank being a backstop for NBFIs in general. Thanks.
Okay, let's take these questions in order. So David, you go first.
Yeah, sure. Thanks for the question. And also I'm very interested to hear about your paper. It sounds closely related, so I'd love to see that. So where do the non-banks get their funding from? Well, we do have quite a wide range of non-banks in our data set, which means that there's no kind of simple answer. I mean, what I can do is I guess the first step is give us a negative answer. I mean, by definition, or at least as we define them in our paper, they don't get funding from retail deposits. So that's sort of the definitional difference. So they're all kind of wholesale funded one way or another. I mean, some of them will be kind of institutional investors, pension funds, and so on, which will have kind of long-term funding sources. But a common feature across quite a few of the non-banks, particularly those who do seem to be exhibiting this behaviour that I was describing of relative increasing lending when monetary policy tightens, quite a few of them do use quite a lot of short-term wholesale funding. So we have kind of broker dealers in there who'll be using quite a lot of repo. We have finance companies who'll be using quite a lot of commercial paper, including asset-backed commercial paper. And so one potential mechanism that could explain or contribute to our results and could work through funding markets is this idea that in times of monetary tightening, you get flows of funding into money market funds. These are obviously then big investors in the kind of markets, the commercial paper and repo markets I'm discussing. And so some of this could then be essentially deposits being recycled via money market funds back into certain non-bank lenders via money markets.
Yes, so on the procyclicality, so in fact, the pension funds have been exempt from central clearing for a while, and precisely they were using this reason that, well, they can just go to the central bank and get cash if these margin calls occur. But so they have been exempt for a while, but now they have to post everything in cash, which is leading to those cyclical movements that I showed. Now, the data that I have, so it's like monthly holdings data. I only have them for all the Dutch counterparties on a monthly basis. So I don't capture the full market. So I have been trying to like figure out who is on the other side, but that turns out quite difficult. Now they are selling the fairly like shorter term bonds, at least with maturities below 10 years. So I suppose that like that's at least easier to get rid of than say they're very long term bonds that they hold. But unfortunately, I'm not able to give a very precise answer. But it would be worthwhile to figure that out.
I just want to pick up on procyclicality really quickly. I come at it from the perspective of US funding markets. So if you look at repo markets, 70% of repo has no margin whatsoever. So I think that there is a procyclicality issue in CCP margining that can be improved. And I think that there's a number of ways to do that. But I think the sort of the most procyclical form of margining is one where you have no margin today, and then you hit volatility and you introduce margin tomorrow, or you even cut a counterparty off altogether. Like that is the most procyclical form. And so that is the thing that I think you could address first, is like have some regime in place. And then how do you make improvements to the regime to make it less procyclical? So I just wanted to make that point. You weren't arguing the counter, but I just wanted to make that point. And then real quickly on the paper about lending to NBFIs, perhaps through repo operations, like it raises questions about, in my mind, about what transaction types, what trade types should you care about as a central bank? Is it the cash futures basis trade? Is it the swaps trade? Is it on off the run treasury, spreads? So it raises a lot of questions about what trades you care about. There's questions about the instruments, whether there's legality of the Fed operating in those types of instruments. And then what are the types of counterparties that you think should have access to central bank liquidity directly? Those are all very big and very important questions that I think would need to be answered. And in the first instance, I'd take the tools that you have and make sure that they work efficiently. So that's why I talked about centrally clearing the standing repo facility, because it's sort of an obvious way to take a friction out of the implementation process that I think could address all sorts of counterparties in the treasury market, for example. I mean, the treasury market's an over-the-counter market, and it requires intermediation. And I think making sure that intermediation works would be the first step I'd take.
Dick, did you have a question?
Question and comment. Why did you get the microphone?
Stein had a response to that.
Very short.
So, two things. One, So in support of best practices, which, I have some skin in the game with because Nate led at CFTC in the Market Risk Advisory Committee, a work stream that we both participated in talking about best, or we call them effective practices for risk management in this trade. I think one of the key things that you shouldn't overlook is that it solves a collective action problem, because in that committee, we had people from both sides of the table. And to get agreement, I can assure you, is not easy in the context of these discussions, having been through it for the last 5 years. But once you get agreement on that and you come up with some best practices or effective practices, then people can always draw on those to force people who are deviating from them and saying, well, didn't you agree to this in the past? And I think that has broad applicability. So the PFMI, the Principles for Financial Market Infrastructure, is really a great example. Bill, who's here, worked on that a lot. And I think we always, adduce those things when it came to thinking about, well, what do you think about this? Well, does it conform to the PFMI? So I think there's a collective action issue there that, really this helps solve. On your data question, having worked on that for 6.5 years at the OFR, one of the things we tried to do is to make sure that the data were not only of high quality and fit for purpose, but also that they were accessible. And in our financial system, where we have a fragmented regulatory structure, sometimes getting access to data, even among the regulators, is a big challenge. And so what you get in response to that is duplication of collections with different standards. I can cite chapter and verse, I'm sure Nellie and Don can as well, where these things were fragmented. So one thing that is very useful is to have data standards that everybody accepts, and to think about the duplication of data collection to reduce the reporting burden on financial institutions and intermediaries. That's an ongoing challenge, but it's one worth fighting for.
Stein, why don't you have the last word, knowing that you are the only thing in between people and their lunch?
No, you may have still more time because I don't want to take the last word necessarily, but it's just on what you said, Dick. Best practice is good, but there has to be a stick, and that's a lesson from self-regulation and more generally. So we need to have some backup on data. Obviously, agree that I want to bring that concretely to the point of the pro-cyclicality of margins, which was a big analysis for the FSB. One regulatory agency in the US of blocking the data sharing, you can imagine, for years. What did come out finally of the data, it was very interesting that the ones that are in the bilateral market are much less pro-cyclical than in the regulated market, which makes you think that the risk models that they use are not necessarily looking through the cycle in a more cohesive way, or don't have the discretion that you want. And the other complementary thing was that this is a separate piece of analysis. The skin in the game of the CCPs determines the risk management model that they adhere to and impose on the other agents. So we need to improve the skin in the game. And I think the skin of the game, again, goes back to my franchise argument. If you have a CCP, you have a franchise forever, because they're not going to disappear. We can talk about failures, etc. But some CCPs are so big, we know we can't get around them. We give them a return for indefinite, but we don't ask them for skin in the game. We allow them for high dividend payments. There's some inconsistency here that should be rectified.
We've asked, but we haven't got.
Yes.
Okay, all right. I think this is the end of our time. Am I wrong about this?
15 minutes.
Actually, you had
I thought it said 11:45. All right, let's go. Yeah, thank you. Okay, thank you very much.